There is a number on your national insurance record right now that is quietly deciding how much state pension you will receive for the rest of your retirement. Most people have never looked at it, and some of the people who have looked at it have accepted what they saw without knowing that what they are looking at can still be changed. That gap sitting there marked incomplete can be filled. That a weekly pension that currently shows as lower than the full amount does not have to stay lower, and that there is a window to do something about it that closes permanently on the 5th of April each year. Welcome back to HMRC Update. Today, I want to go through the national insurance update that matters most for your state pension right now, what changed in April 2026, who it affects, what filling a gap actually costs and returns, and the one step that must happen before any money changes hands. If you are not subscribed to HMRC Update, please do that now and hit the bell. The state pension is the most important financial outcome of your working life, and the decisions around your national insurance record determine it permanently. Subscribe. Let us get into it. You generally need 35 qualifying years of national insurance for the full new state pension, and at least 10 years to receive anything at all. The full new state pension in 2026 to 2027 is £241.30 per week. £12,547.60 per year. Every qualifying year below 35 reduces that figure by 1/35, approximately £6.89 per week. A person with 30 qualifying years receives approximately £206 per week. A person with 25 qualifying years receives approximately £172 per week. Those reductions are permanent. They do not self-correct. They do not average out. The years on the record are the years that count. If there are gaps in your national insurance record for any of the previous 6 tax years, it might be beneficial to pay backdated voluntary national insurance contributions to increase your pension. Entitlement. The 6-year window is the standard rule. Right now in August 2026, the earliest gap year you can fill is 2020 to 2021. That specific year has until the 5th of April 2027 before it closes permanently. 8 months. After that date, 2020 to 2021 drops out of scope entirely. Not deferred, not available at a premium, gone. For the 2026 to 2027 tax year, one Class 3 qualifying year costs £962 and adds approximately £358.50 per year to your state pension for life. The break-even period is around 2.7 years after retirement. 2.7 years. Average life expectancy at 66 in the UK is 19 to 21 years. On a 20-year retirement, one purchased qualifying year returns approximately £7,170 in additional state pension against an upfront cost of £962. The expected lifetime benefit is roughly 7.5 times the cost. As financial decisions go, it is one of the most straightforward available to anyone approaching retirement with gaps in their record. But here is the step that cannot be skipped, and that most people getting this wrong are skipping. Before spending a penny, check your state pension forecast. Confirm that filling the gap will actually increase your pension. If you are already forecast to reach the full amount through future working years, paying for old gaps may add nothing. This is the reason the phone call comes before the payment. Some people with gaps in their NI record are already forecast to reach 35 qualifying years through the remaining years of their working life. Paying to fill a historical gap in that situation returns nothing. The pension is already heading to the full amount without it. Others have gaps from contracting out of the additional state pension before 2016, and the way their starting amount is calculated means filling those specific gaps does not increase the pension figure even when the record appears incomplete. The Future Pension Center at 0800-731-0175 confirms which gaps will actually increase your pension and which ones won't.
Not. That call is free. It takes 20 minutes. It is the difference between a purchase that returns £7,000 over retirement and one that returns nothing. Drop a comment below if you have checked your national insurance record and found gaps you were not aware of. Back to the most significant change in the NI landscape this year. Starting April 6, 2026, the UK government eliminated voluntary Class 2 national insurance contributions for anyone living or working outside the UK. Expats who previously paid £3.50 per week, £182 per year, to maintain their UK state pension record must now pay Class 3 contributions at £17.75 per week, £923 per year, a 5-fold increase. HMRC estimates that approximately 46,000 individuals currently paying voluntary Class 2 NI contributions from abroad are affected by this change. These are UK nationals who have been using the cheap Class 2 route to maintain their record while living abroad. That option closed permanently on the 5th of April 2026. There is no reinstatement. There is no transitional arrangement beyond the final year's payment that people had already applied for before the deadline. The return on investment changes significantly. At £182 per year, filling an overseas NI gap returned approximately 15 times the cost over a 20-year retirement. At £923 per year, the same return is approximately 7.5 times the cost. Still positive, still worth doing in most cases where the gap will genuinely increase the pension. But the calculation is no longer the near automatic decision it was at Class 2 rates. Starting April 6, 2026, the new 10-year eligibility rules apply for overseas contributors. To pay Class 3 for periods abroad, you need either 10 consecutive years of UK residency immediately before going abroad, or at least 10 years of national insurance contributions before the period abroad. For someone who left the UK in their mid-20s with only 5 or 6 years of contributions, the new eligibility rules may mean
they no longer qualify to pay voluntary contributions for overseas years at all. That is a permanent change. Checking eligibility before assuming it exists is the first step for any UK national living abroad who wants to maintain their record. For UK-based workers with domestic gaps, the rules are unchanged. Class 3 voluntary contributions remain available for the last 6 tax years, and the decision framework is straightforward. Check the forecast, confirm the gap increases the pension, then pay if the return justifies it. There is one more thing worth knowing that can significantly reduce the cost, and that applies to a group who often do not realize it. If you were self-employed in a gap year, even with low profits, you may be entitled to pay Class 2 rather than Class 3 for that domestic gap. Contact HMRC to check. The saving is approximately £724 per year per gap year. Class 2 for domestic self-employment periods was not abolished in the same way as Class 2 for overseas contributors. For self-employed people with profits below the small profits threshold in a given year, Class 2 voluntary contributions may still be payable at considerably lower rates than Class 3. A sole trader who had a low profit year in 2022 to 2023 and assumed Class 3 is the only option may be able to fill that gap at Class 2 rates instead. Confirming this with HMRC before paying anything could save several £100s per gap year. One more consideration before paying voluntary contributions, and this is the one connected to tax that most people do not factor in until it is too late. You usually pay income tax if your total income is over £12,570 per year. The extra state pension generated by filling a gap adds to your total income in retirement. If your pension and other income already push you above the personal allowance, that additional £358 per year from a purchased qualifying year is taxable. At the basic rate, 20% of that additional pension goes to HMRC, meaning your net annual gain is closer to £286, not £358. The break-even period extends from 2.7 years to approximately 3.4 years. The decision still makes sense for most people, but the after-tax return depends on your total retirement income picture, and that is worth calculating before committing. So here is the complete action list from everything covered today. Go to gov.uk/check national insurance record and sign in with your government gateway account or gov.uk one login. Review your record year by year. Each year will show as full, a gap, or a partial year. Then go to gov.uk/check state pension to see your current forecast and how many more qualifying years you could add. Before paying anything, call the Future Pension Center on 0800 731 0175. Ask specifically which gap years will increase your state pension forecast and which will not. Do not pay for a year that returns nothing. If you have a gap in the 2020 to 2021 tax year, you have until the 5th of April 2027 to fill it. After that date, it closes permanently. If you were self-employed in any gap year, even with low profits, contact HMRC to confirm whether Class 2 rates apply to that year rather than Class 3. The potential saving is over £700 per gap year. If you live or work abroad, Class 2 ended on the 5th of April 2026. Class 3, at approximately £923 per year, is the only option for future overseas periods. Confirm eligibility under the new 10-year requirement before assuming you can still contribute. And factor your total retirement income into the return calculation before paying. If your pension and other income will exceed the personal allowance, the after-tax return on additional state pension is lower than the headline figures suggest, still positive in most cases, but worth knowing before you commit. Your state pension is not fixed. The number sitting in HMRC system right now can still be changed.
upward by specific actions taken before specific windows close. The 2020 to 2021 window closes
in 8 months. State pension age closes the window permanently. Share this with someone approaching retirement who has not checked their national insurance record recently. 5 minutes at gov.uk and one call to 0800-731-0175 could add meaningful income to every week of their retirement for the rest of their life. Subscribe to HMRC Update if you are not already here.